first thing, I'm sorry for my hiatus. It was not intentional. I just screwed up. I mean, I had a slew of episodes in the can, and all of a sudden, a number of people canceled, leaving me without episodes. So I apologize. I'm normally a pretty consistent guy. So this week, we're going to talk about DealStats. The first quarter 2020 review just came out. And for those of you that don't know about DealStats, this is the market data that most appraisers use for the smaller companies, under $20 million in revenue. And it's produced by Business Value Resources, which, they've been collecting private company data for, I'll bet you 30 years or so. This installment of DealStats is an interesting one. We're going to talk about some of the decreasing earnings multiples that are coming out. So let's get into it. Thanks for listening.
Please welcome.
This is another episode of the Defenders of Business Value podcast, a podcast where we talk about what makes a business valuable, learn the tips and tactics to increase your company's value that only veteran deal makers know. And now, here's your host, Ed Meisogland.
So the first thing we notice in this latest report by DealStats is that the EBITDA multiples have declined again. And EBITDA, for those of you that are unfamiliar with the term, it's earnings before interest, taxes, depreciation, and amortization. It tends to be a useful metric for valuing companies. So over the last 4 of the 5 quarters, that the EBITDA multiples have decreased. And so that's pretty interesting. What does that tell us? I don't think that there's necessarily a challenge on the horizon. I think that we're seeing a lot of business owners that have held on to their companies and probably have not reinvested. And as a result, buyers are penalizing the sellers for some of that capital expenditure that they're going to have to make. So as we look at the EBITDA margins or multiples and margins, the interesting thing is that the EBITDA margin across all industries seems to remain steady at 11%. And then as we look at across all industries, the EBITDA multiple is 4.4. So some of the higher performing company or industries that we're seeing, let's see, I'll give you the top 3. Information services, which shouldn't be a surprise to anybody. I mean, information, anything related to information and the sale or the use of it, certainly commands a premium. Next is mining, quarries, oil and gas extraction. That historically has always been a fairly aggressive area to be in. That multiple is running roughly at 8.6. And then coming in third place is finance and insurance. So it's probably a pretty good time to be in that space also. Next, we'll talk a little bit about pricing multiples and profit margins. And the first thing I guess I want to address is that size matters in business valuation. So the larger the company, the higher the multiples. It's just that way. And the reason, it's critical mass. I mean, when a large company has a bump in the road, you don't necessarily feel it as much as if you have 1 or 2 people in your shop and something happens to one of them. And so, at any rate, that's keep that in mind as we continue through this. So as we look at the median selling price to net sales, it is, the larger companies are running roughly about 1.4 times revenue. But the smaller companies, and when I say that, I'm talking 0 to 10 million in revenue. I mean, it is virtually identical. And that's coming in just roughly 50% of revenue, which, believe it or not, happens to be a real rough rule of thumb. So and it, by the way, and it has been that way since 2010. So over the course of a decade, there's not a whole lot of volatility in the revenue multiple. And I guess what I'd like for you to take away from this is, multiples. And granted, you have to do some value work, but generally speaking, the multiples when you're dealing sub $10 million in revenue, it's just not a wild ride like it is in the stock market. Multiples stay roughly the same. And so over the course of the 10 years, the larger the company, the 5 to 10 million had a little bit of variability, but the 5 million and below, they just tracked pretty much the same at roughly 50%. So then when we look at multiples, same kind of thing. The larger the company, the higher the multiple, with exception of this year for the 10 million and greater. Again, the multiple keeps dropping a little bit. It's, and this is when I say the multiple here, this is seller's discretionary earnings, and the calculation for it is you add to the net income your EBITDA. All right, so your earnings before interest, taxes, depreciation, and amortization, your direct officer's compensation, and any discretionary or non-recurring expenses. And that'll give you your SDE or seller's discretionary earnings. So as we're looking at the median selling price for your believe it or not, the 5 to 10 million dollar multiple jumped a little bit between 2018 and 2019, up to about 3.8, 3.9. Same thing with the 1 to 5 million and the sub $1 million revenue companies. I mean, it's tracking between 2 and 3. And again, that's across all industries. That's not to say that it doesn't. That's not to say that other industries have higher multiples, but as an overall look at small business deals, they're tracking roughly between 2 times and 3 times SDE or seller's discretionary earnings. Next, let's look at industry pricing multiples and profit margins and how they compare. So DealStats did an analysis across 18 industry sectors. And when we look at the target companies that have within industries that are asset heavy, meaning that there's a lot of tangible assets, they clearly trade at higher revenue and earnings based multiples than other industries. And so probably you're asking yourself, why is that? Well, it's likely because credit is so good right now that you have an awful lot of leverageable assets that facilitate premiums being paid. So as we look across all the 18 industries, your average multiple of revenue is 54%. Now, some of the higher producing multiples would be ag, mining, utilities, certainly manufacturing, information that I mentioned earlier, finance, real estate, professional services, just to name a few. And I think that was 6 or 7 that are above the median. Now, as far as what's dragging, well, as you might expect, retail. So anything that is going up against Amazon, they're sucking wind a little bit. So the next couple things I want to talk about are the discounts between asking price and sale price, as well as the time it takes to sell a company. So first one, the discounts. So what we're seeing, and what DealStats has confirmed, is that there is a little bit of a discount between asking price and sale price. And right now it is approximately 87% of asking price. And I think we're seeing the same thing in our shop. One of the things that has considerably changed the landscape of the deal making, at least in our place, is doing valuation work. Those business owners that come in cold and just want to go to market without doing a lot of understanding what creates value in the company, we're just in a little bit more of a difficult situation to effectively sell it. Now, I can tell you those that do valuation work and those that learn how their business is going to be viewed through a buyer's eyes, it's an entirely different situation. And almost we're running between 70 and 80% success ratio when we do that depth of analysis. And for you business owners, I would strongly suggest that you get a hold of somebody that does value work and help you understand how a buyer is going to look at your business when that time comes to sell. So next, the time to sell a company. This has been fairly consistent too. And again, this is across all industries, but all private targets that we're looking at. And it's running roughly 214 days over the course of the 6 years that I'm looking at. In 2014, 15, and part of 16, I mean, it was running a little shy of 200 days, and only 17 through the end of 2019 are we getting above the median of 207 days. So, I mean, if I'm a business owner, I'm planning on, it's going to take 9 months to sell the company. So that's about it from DealStats. I'll have a link so you can go to DealStats and download this report. Now, obviously, they're going to ask you for your contact information in order to get it, but nevertheless, it's a good, if you follow valuations, it's a real helpful tool to see what's happening. So the main takeaways that for you business owners out there, those sub $10 million companies, those multiples don't vary widely. So for planning purposes, getting some guidance on value should be able to lead you to a successful exit. And as always, if there's anything that I can do for you, I would be happy to share what I know, and I'll be candid when I have to turn on the meter. So thanks so much for listening, and I'll see you next week.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.